Welcome to MF Global Managed Futures. This presentation is being recorded on September 16, 2011. Today's presenter will be Holliston Hurd with FTC. Futures trading involves a substantial risk of loss and is not suitable for every investor. Past performance is not necessarily indicative of future results. Please consult the CTA's respective disclosure document for program details including performance, risks, fees, and drawdowns. Welcome, Holliston.
Thank you. Thank you so much to MF Global for allowing me to talk more about our Managed Futures program. What you're seeing on this slide is a full disclaimer and risk disclosure on our trading program, and we hope that you'll read both disclosures more at your leisure. So I want to get started with the question we get asked a lot, why FTC? And there are really three reasons. The number one is our performance, and particularly measured against risk. Our Sharpe ratio is 1.5%. The second reason is our lack of correlation, not only to the S&P 500, but also to the overall CTA industry as measured by the Barclays CTA index. And the third reason is our diversification, and we're diversified in three ways. First of all, we trade a highly diversified portfolio across different sectors. The second level of diversification is our strategy diversification across 4 strategies. And then in each of those strategies, we trade different time frames. So that gives us our third level of diversification. Going a little bit deeper into why FTC, our team of managers has over 25 years of experience, and this is experience in the research of trading strategies, the development of trading strategies, consulting with other firms regarding trading, and actually managing funds in the CTA space. FTC had a joint venture with a CTA managing significant assets from 1991 to 2002, and we have the same team in place that we did at that time. That CTA was a reversal strategy, and it was sold to a larger CTA, the actual strategy. This slide gives you some of our performance statistics. Our standard deviation 13.7. The maximum drawdown, and this is on a month-end basis, peak to trough, has been 9% over the life of the program. We've been trading since October 2007. That's 45 months, and we have positive returns on 66% of those months. And then you see our correlation again here. So what do we trade? The strategy overview. What we did back in 2002 was we developed a series of strategies called the Samurai strategies, and we chose 4 of these strategies that would deliver the kind of return and risk we were looking for. All of our strategies use pattern recognition, counter trend, short-term trend following, and momentum strategies. Now when we define short-term, relative to the industry, our definition of short-term is extreme short-term. So our trade duration on 50% of our trades is a holding period of between 2 and 5 days. 50% is short-term, which is a holding period of 5 to 14 days. So what I mentioned before, where we developed a series of Samurai strategies, shortened the name to SAM, the MS4, Multiple System 4, is made up of 4 of these strategies. The first one, which we call SAM 101, is our shortest term strategy. And in this one we use an algorithm to recognize patterns. We also measure the current market volatility, and this gives us a trade duration of between 2 and 5 days. We use daily data as our input on this strategy, and our daily data includes open, high, low, and close. The SAM 007 is a little bit longer in duration, 2 to 7 days. Again, we use daily data inputs. But this strategy is looking for short-term trend direction and trend retracements. The third component is our longest-term strategy, the SAM 004. We call this an intermediate-term trend follower with a trade duration of between 7 and 20 days. And this is a pure stop and reverse strategy. The fourth component, SAM 200, is short to intermediate term with a 4 to 8 day holding period. But this strategy uses daily and weekly data input. So the weekly bars being the open of the week, the high of the week, the low of the week, and the close of the week to give us our trading signals. The program itself is 100% automated. All of these, and when I say automated, the strategies go into all 4 of them go into our overall system to deliver buys and sells in each of the 4. We don't leave resting stops, however, so it's not automated in terms of the actual trading. We use electronic execution for our actual trading, but the system is 100% automated otherwise in terms of there being no discretion. So our diversification, the way we choose markets, that's another question that a lot of people ask. How do you choose what you trade? We chose 14 markets, and it's based on, we wanted to be diversified across sectors. We also wanted highly liquid markets. So each of the 4 strategies call from 14 markets. We equally weight across sectors. So a sector would be the interest rate sector, the currency sector, the grain sector. We allocate our capital across the sectors. And then we also measure risk based on the current volatility and the current price. The risk management is an overlay algorithm, and this governs our positions, in other words, the number of positions we will hold and our sector exposure. And then you see under markets traded the 14 markets that we are culling from. So what is our risk management? We start by allocating across the 7 sectors. We want to limit exposure in any one particular sector. We allocate to specific trades based on market volatility and price. Because there are 4 strategies, there are times when 2 strategies will be long, for example, bonds, 2 strategies will be short bonds. That effectively leaves the account flat. If, for example, all 4 strategies were long the bonds, we would hold 4 bonds long, unless the market volatility and the current price was over our risk limit for that particular sector in that particular market. On the day of entry, we do use volatility stops, and stops are recalculated on a daily basis. Our individual market risk on a particular position is targeted to be between 0.3 and 0.6% of capital. Our daily risk on the overall portfolio is targeted to be between 1.5 and 3% on a daily basis. Now, this is not to say that we can't have a larger drawdown on a particular day, but what we target in our research and what we're targeting in return and risk, we target an overall portfolio risk of 1.5 to 3% on a daily basis. We do have a capital allocation model which overlays our strategies, and we're looking to keep an efficient portfolio, and this is our edge in terms of our mechanical allocation model. So as I said before, we allocate across sectors based on this formula and predetermined risk exposure. We do monitor our variance on a daily basis and on our portfolio sizes, and we adjust those whenever any one particular market or sector is at a higher risk level than the system allows. Who makes up FTC? FTC was founded by John Hill Sr. He's been a trader for many, many years prior to when there even were computers. And he had patterns and strategies that he wanted to computerize. And that was when he hired George Pruitt. He's written several books on developing strategies, building strategies, and trading, and has been a consultant for many, many years. George Pruitt has been with the firm for more than 22 years. He is our computer specialist. And what he did when he joined the firm was he built a testing platform that is a state-of-the-art platform that allowed John Hill Sr. to test his formulas. The name of that program is the Excalibur Testing Platform. And it is it's what we've used since the very beginning of our firm, and many people have asked us to test their strategies using our Excalibur. There's nothing out there that exists like Excalibur. Myself, I'm the director and head of marketing. I've been a trader for more than 20 years in the industry. I was the owner of Hill Financial Group, which was the CTA, managing about $177 million. Using Futures Truth as our research arm, our back office, and our trading desk. We have the same team in place that we had when we ran $177 million. Joe Bobak is our head trader, and Jessica Bonnet is our administrative assistant. So a little bit about the history of the firm, which you've heard over the course of the presentation. Established to do research in 1985, the Excalibur was built to test strategies. We consulted with banks, and many large CTAs came to us to tweak their trading strategies. From 1991 to 2002, FTC was in a joint venture assisting in the management of Hill Financial Group, which grew to manage significant assets prior to being sold in 2002. Then FTC went back to research, particularly on directional strategies. This is when we did a lot of consulting and developed the Samurai series, which was later put to work with the MS4, which we opened to investors in October of 2007. Our investment philosophy always been directed towards the short-term end of trading. Research has always been the cornerstone of our firm. We are looking to develop competitive returns that have a low correlation to other CTAs. We are not trend followers. We are short-term traders. And because of that reason, I think that's what delivers our low correlation or non-correlation to an industry that is primarily made up of trend followers. Our goal is to offer a robust strategy that delivers attractive returns regardless of what's going on in world economies. Excuse me. Our program information is seen on this slide, and we trade about 3,500 trades per year per million. Our margin can run from 7 to 25%, generally on the lower end, generally under 15, closer to 10 on an average basis. There are times it could get higher than that. Funding requirements, we would like 50% funding on a $500,000 account, so you can fund this with $250,000 and trade it like 500. And that's the end of my portion. I want to thank MF Global and Paul Rieger for allowing me to tell you more about our strategy. And on the last slide, I'll turn it back over to MF Global to give you the contact information for Paul Rieger.
Thank you very much, Holliston. Great job. If you'd like any more information on FTC or any managed futures, you can go ahead and give our global executive, Paul Rieger, a call. He's our managed futures specialist, and you can call him toll free at 800-273-4899. Again, futures trading involves substantial risk of loss and therefore is not suitable for all investors. And of course, past performance is not necessarily indicative of futures results. Thank you and have a great day.